Hello, so I am graduating this year with an undergraduate with a bachelor's degree in economics, and I'm starting a master's of science in quantitative economics next year. So I have been through the ringer at this point with economics courses, and I have finished up those first degree requirements. And I really like economics, right? I really like economics. I started writing books about finance and the stock market when I was in middle school. And then this channel, if you go to videos a year ago up through today, I've made a lot of videos like these about economics, finance, game theory, just the whole 9 yards there. But I don't think I knew how much I liked it until I started getting really deep into it. And if I had seen a video like the one I want to make today when I was a freshman or when I was considering what kind of subject to study, I think it really would have helped me. So I'm making this video for two groups of people. First, if you are a prospective student or you're thinking about studying economics, then you'll learn a lot about the degree, what it's like, what's good, what's bad, and a lot about economics itself in this video. So that's one group. And then for the second group, if you're watching this and you're just interested in economics and you want to learn about kind of what constitutes quote-unquote economics and how it's actually taught, and then also just a lot about economics itself and every kind of facet of it that builds into this whole domain and this field, then this video is also for you. So there are four big parts to any education in economics. There is microeconomics, which focuses on individual consumers and firms and how they act, what they do. And then there is macroeconomics, which focuses on whole countries, nation states, markets. And then there is econometrics, which is much more of an applied form of economics where we use data to just answer questions, answer economic questions about the world. And then finally, there's what in the college system you'd think of as electives, and really that's just any number of kind of subfields that people go really deep into, right? Like there's sports economics, there's economics of information, there's game theory, there's political economy, there's this whole breadth of subjects where you take micro, macro, and your econometrics tool sets, and then you apply those to very specific fields. You can also kind of consider behavioral economics its own thing, and game theory is somewhat distinct as well. But those subjects are still considered kind of more niche or take a backseat to just that main educational curve that people go through of your micro, macro, and your stat and your econometrics. So I'm going to first start with microeconomics and just break that down as a whole, then get into macro, then econometrics, and then into all these various electives that I took and also just really enjoy, right? Things like game theory, economics of information, political economy, public finance, and the like. Now in this video, we're talking about economics and money, and many people are looking for ways to grow professionally and create additional income streams without sacrificing their time and freedom. So I want to share an opportunity with you to learn valuable skills and generate an income from anywhere in the world on your own schedule. So meet Prop 365. Prop 365 lets you trade financial markets using company demo accounts as opposed to your own personal funds. Unlike regular retail traders who trade with their own money, prop traders work for a firm that provides them with demo accounts in exchange for a share of the profits. And in that way, you can potentially earn from the markets without having to risk your own capital. All trading is done on simulated or demo accounts, but payouts are real and you keep up to 80% of the profits you generate. And you can trade across crypto, commodities, stocks, and Forex with account sizes ranging from $5,000 up to $100,000. This is a great way to learn new skills, develop professionally, and create an additional income source while maintaining control over your time. So to get started, just register on Prop 365, then purchase a challenge using the 30% discount code in the description, and that makes it only $39 to get started. So then once you pass a challenge, you unlock access to a funded simulated account and qualify for those real payouts. And your challenge fee is refunded after that first withdrawal. And Prop 365 recently added a new simplified challenge called Two-Step Max that's designed to be simplified and accessible for beginners. These guys are ranked number 2 among all prop firms on TradeLocker as of March. And so one last time, if you're looking to take that next step toward financial growth and develop new professional skills and create an additional income stream, then Prop 365 is a great place to start. Use that exclusive 30% promo code in the description below and start your journey today. Again, there are zero capital requirements, fully funded accounts, and an 80% profit split. That said, let's get back to economics. Okay, so I'm going to dive into the first layer of economics as we just touched on, which is the duality of microeconomics and macroeconomics, and I'm going to do so through the lens of the classes. And you start off typically with two layers of micro and macro courses. So typically at most universities and whatnot, that's Microeconomics 101, Macroeconomics 102, and then Macro 201, Macro 202. So in the next few minutes, I'm going to walk through not necessarily what I find most interesting or what's most applicable, but basically a little introduction to everything that you're going to learn about should you pursue economics. And also if you don't want to study it, if you just want to learn here, this is basically a touch point on everything that you can go deeper into. So it's not going to be super academic, super mathematical, focused. We're just going to touch on kind of all the core parts of micro and macro. And that starts with microeconomics. And microeconomics is much more focused on the consumer and on the individual kind of behaviors of consumers and of firms. And so the first kind of theory there is consumer theory, and that deals with consumers, so people just like you and me, and how do we act? How do we act? Why do we act? How we act, and how can we predict our behavior? And generally, utility maximization and consumer choice is how we view consumer theory. So we view it through the lens of consumers have choices. They can buy a certain good, they have a certain amount of money, and then they want to maximize their utility or their satisfaction. And in economics, what we call utility is kind of this arbitrary kind of catch-all term for value, right? In that it's hard to categorize or it's hard to generalize the notion of how much things matter to us. Like if you had to say, bananas matter to you on an arbitrary scale of 2. They're worth 2 of this, this unit to you. And then I asked, well, how many units is a good friendship worth? And how many units is a computer worth, right? It's kind of hard in practice to say the banana's worth 2, the friendship's worth 156, and so on. But in theory, this is all utility, right? All these goods, right? So the computer, the friendship, the banana give us different value, different amounts of value, and we're going to spend and allocate our time and our money in different ways to get those things. And so what we call like value, so to speak, in economics is just utility. And so in the general consumer theory, you have limited resources, right? You have a limited amount of time, you have a limited amount of money, and so you're going to try to get the most value out of your day, out of your money, and we call that utility. So you're trying to maximize utility given the choices you have, and then give it the limited resources or the budget constraints that you have. And so something you'll hear a lot is the notion of margin, or like at the margin, and then marginal revenue, marginal cost, and in this case, marginal utility. And what all that means, and all it means if you hear the word marginal, is just one more, like at the edge. So if you've already spent $100 and you got 8 units of utility, like it's worth 8 to you, and whatever that means, then the marginal utility is the utility you get from consuming the 101st unit. And that matters in a lot of ways. It matters in firm theory and choice that we'll look at, and also consumer theory. And rational consumers, and we're not all perfectly rational humans, in terms of how we allocate goods, but generally what we do is we allocate spending so that if we spent $1 more on any number of things, we would get the same amount of value for it. Because if that doesn't hold, if we could get more value at the margin by putting money in one place for another time and another, then that's where our money would go. And so rationally, to hit this kind of equilibrium, and an equilibrium is kind of like this stable state where no one wants to do anything differently, then, well, we're going to get the same value from spending our money in a lot of different places. And you can expand dollar to time and so on. So this is just a little equation here. It just says the marginal utility of X divided by the price of good X equals the marginal utility of y over the price of y. So that says for any two goods, x and y, we can generalize that to any goods, which is just what we said here, the marginal utility divided by the price, which is equivalent to the marginal utility per dollar, is equivalent across the board. And then you can see that the income and the substitution effect are two big things that you're going to see a lot. And what they just reflect is how the amount that you consume changes and why it changes. So if you make more money and now you buy more of one good versus another, then that was the income effect. Your income changed, you make more money, now you buy more, let's say, steak versus your kind of mac and cheese that you make at home and throw in the microwave. And then the substitution effect is the same kind of logic there, but it relates to the price of a certain good. So it says that, well, and we'll talk about kind of difference curves and all that in a minute, but it just says if the price of a comparable good changes, then, well, how are we going to allocate our spend now? So let's say if apples get more expensive, well, are we going to buy more oranges or are we going to buy more bananas? So that is a little intro to consumer theory. Next, I want to talk about budget constraints and indifference curves. You'll hear a lot about this in every economics course you take and just in kind of every application in the real world of economics as well. And the budget constraint is just what I said here, where as consumers, we have limited resources. We don't have infinite money. We definitely don't have infinite time. And so what we call that limited kind of amount of resources is the budget constraint. So if you walk into a store, let's say a supermarket, and we're considering that supermarket to be the market, right? And you have 20 bucks in your wallet that you're willing to spend and you want to get a snack. Like let's say you walked in, you want some sugar, you want a drink, you want a snack. Well, the $20 is your budget constraint and you're trying to maximize utility in this market, or basically you want to get the most enjoyment from the snacks, the candy, the drinks that you buy. And the budget constraint is going to be equivalent to the different allocations that you can make, how you can spend the price of a good X times the quantity plus the price of good Y times the quantity. And then that's going to be just the same for every good. So if your income, like let's say in that example, $20, right, is your budget constraint, then $20 has to equal the price of, let's say you can only choose between Coca-Cola and a Hershey's chocolate bar. And the price of Coca-Cola is $2 and the price of the Hershey's bar is $3. Well, your $20 has to equal some amount of Hershey's, which is just $3 times the amount that you consume, and then plus $2 for the Coca-Cola plus the amount of Coca-Cola units that you buy. And then that translates into the idea of indifference curves. And indifference curves just say that I get the same amount of value at every point along this curve. So if I buy, let's say, 2 units of Coca-Cola and 1 unit of a Hershey's bar versus, let's say, 2 units of a Hershey's bar and 1 unit of Coca-Cola, I would be just as happy. I would be indifferent to those two what are called bundles of goods, or those two allocations. So you can see this right here, right? Like let's say in this case you have a curved curve, like an indifference curve right here. At any point along this line, and this is actually a little bit different. This is in production possibilities frontier. But let's just think about this as a indifference curve for a second. We can say at any point along this line, we get the same amount of enjoyment from those two goods. So let's say at this point right here where my mouse is, maybe that's, let's say, 7 units of good 2 and 4 units of good 1. And if we go up along here, maybe that's 2 units of good 2 and 9 units of good 1. And what we're saying here is that at any point along this curve, so at those 2 points I just mentioned, we would get the same amount of value there. And then this relates to, again, what I said here, which is like you want to maximize utility. We can find the optimal consumption, or optimally how you can actually get the most value from the different goods you can buy, by then looking at things like derivatives and the tangential points and so on. And what we can do is compare the indifference curve and the budget constraint, and the point at which the budget constraint hits the highest or the most valuable indifference curve, since the difference curves have fixed utility. So at the highest amount of fixed utility that hits the budget line, well, that's where we want to optimally consume. Okay, so next up are demand curves and elasticity. You'll see a lot about demand curves as well. That's in every course you'll ever take. Demand curves just look at the quantity that is demanded, given typically how you'll see it orchestrated is the quantity on the x-axis and the price on the y-axis. And so typically these are downward sloping. All that means is as the quantity demanded increases, then the price is going to fall because more people are going to produce that. And for individual demand, like you could have market demanded as well, but for individual demand, it's just going to be the quantity desired at each price level. So let's say if the price is $3, we're going to want 2 units, and if the price is $4, maybe we only want 1 unit. And then we can take that from consumer theory into a more generalized like micro or macro view where we just sum all of the individual demands. And then elasticity is something important here. And elasticity, kind of the concept of it, is just how responsive people are to a change in price. In terms of consumer theory. And the example I would give there is if you make, let's say, $200,000 a year, and you buy, let's say, $10,000 of luxury handbags per year. Well, let's say your income goes from $200,000 to $50,000. Like you lose your job, you become unemployed, and now you only make money from dividends in your stocks. Well, you're not going to buy those luxury handbags anymore. And so what that means is you have a very elastic response to the fact that your income changed when we think about this good of luxury handbags. But let's say you drive to the gym and back, and you're going to do that whether you make $200,000 a year or $50,000 a year, because it's your health that really matters to you. Well, if the price of gas goes from $3 to $4 per gallon, or let's say, I don't know, up to $8, you're still going to drive to and from the gym because your health really matters to you. And in that sense, you have a very inelastic response to changes in price there. And we can think about elasticities of demand, of supply, I'd say for now, focus on that core concept of elasticity. So next, that was consumer theory. Now consumers consume goods, they buy things, producers produce goods. And so that's kind of the flip side of microeconomics and of macroeconomics. And there's a few just core parts here that I want to cover. The first is a production function. And a production function, and there's lots of them, but I'll just cover 2 here, basically just describe the things that go into making stuff, right? So like the quantity that is produced, the quantity that's demanded is going to be some function of inputs to production. And typically the ones you'll see are labor, so denoted here as L, capital, which is always denoted as K, and then the A here is technology. So all this Q equals F of L comma K means is that the quantity that is produced is going to be some function of the labor and the capital that goes into it. So maybe some machines and then paying some people to work on those machines to produce whatever good that we're producing. And then you're going to see 2 extremely common production functions. The one they typically introduce to you first is Cobb-Douglas, and then you'll also run into the CES as well. So the Cobb-Douglas right here just says that the quantity produced is some function of technology, capital, and labor, and then this alpha and beta, these exponents here, speak to basically elasticities as well, like we just spoke of. And that's where you can get kind of diminishing marginal return, which just means that, like we spoke of as well, at the margin, you don't get the same value per unit, right? So like the first $100 you invest, or the first, let's say, $1 billion you invest in a business is going to be more valuable and get more output per dollar for the business than the next billion, and so on. And then the CES is kind of taken in part from the Cobb-Douglas, and that's largely the same, and I won't get into the specific differences right now. And then we have isoquants and we have isocosts. And remember, previously with indifference curves, what we did here is we fixed the utility. So we're indifferent to like different bundles of goods across an indifference curve. Well, here for isoquants and isocost, what we're doing is fixing then quantity, the quantity, right, as opposed to, or the cost as opposed to the utility. So in this case, right, the combinations of inputs that produce equal output. So we can spend a certain amount of, let's say, labor on the x-axis, capital on the y-axis, and you can imagine just like a downward sloping curve there, where at any point along that graph, we can, and instead of bundles of goods, we can allocate certain bundles of labor and capital to produce the same amount of a certain good. So there we go. Next up is profit maximization. This is similar to what we just touched on, but now we're trying to maximize profit because that is what firms do, as opposed to utility, because maximizing utility is what consumers do. So just notation here, right? Profit, you'll see it as pi a lot, but basically profit equals your total revenue minus your total cost. So P equals TR minus TC. And then your revenue is equivalent to Q, or the amount of units in a sense that you sell, multiplied by the price per unit, minus total cost, which is made up of your variable costs and your fixed costs. So variable costs could be, I don't know, having to pay a $3 shipping fee per product that you sell, and a fixed cost could be, your monthly rent on your factory, which you have to pay whether you sell 100 units a month or 100,000 units a month. And then we have marginal revenue and marginal cost. So this is, like I said earlier, marginal revenue is the change in revenue from selling one more unit. And then marginal cost, same as the cost of producing one more unit. And so in competitive markets, and we'll talk about this a bit later, but let's say in a market theoretically where there are lots of different people producing it, and it's not a monopoly. We can just delineate it like that for now. It's just, there's not one firm that can set whatever price they want. There are lots of firms. And so what you have to do as a firm is to maximize your profits. You produce up to the point at which marginal revenue equals marginal cost. And if you produce past that, well, what happens? That means the cost to produce the next unit is more than the revenue. You're losing money. That's bad. You don't want to do that. So at any point below this as well, so let's say right here where the marginal cost of the unit is under the marginal revenue, well, now the marginal revenue is higher, so you're profitable, so you're going to keep producing, because if you made one more unit, you would make more money. So this basically just says the point at which you aren't making any more money from producing more units, well, that's when you're not going to produce, and therefore or produce any more, and that's the point at which you have maximized your profits. There's also kind of different timelines or time scales or time horizons, I guess is the word here. There's the short run, then there's the long run. The long run is like when everyone has made all their moves in like the chess game of economics. You're at this kind of like static state, this equilibrium of sorts. That's going to be what happens in the long run. In the short run, you can have a market that's out of sync, right? Like one producer could come in and dump a bunch of goods in at a very low cost. And then the short run is just when that one thing happens, right? When that firm comes in and starts selling a whole bunch of units. Okay, and so now we have supply curves and market entry exit, and what that refers to is when firms decide to enter a given market. So let's say produce a certain good, or say they used to produce like Texas Instruments, the US firm, right? They used to produce calculators, and then they decide to go and produce weapons. Well, why did they decide to enter that market? When did they decide to leave it? That's the whole business we're looking at here. And then you have demand curves, right, that we talked about previously. And supply curves are the other half of that equation. And the supply curve is just going to describe the quantity supplied at each price. So how many units firms choose to produce. And firms look at this through a few of the mechanisms that we've discussed prior. So we have marginal cost curves. So again, the cost incurred by producing one more unit. And then we have average variable cost. And I mentioned previously that cost is delineated into fixed costs and variable costs. So like your rent might be fixed, like it doesn't correlate with the amount of units that you produce, while your cost of raw goods is going to scale with the amount of units that you produce, because you need a certain amount of, let's say, metal in every unit you produce. And so average variable cost is just variable cost divided by the quantity produced or supplied. And then you just get like, if it's $800 to produce 10 unit, you produce 800, that's then $1 is the average variable cost. And so if we put these two curves on a graph, so we can see the marginal cost curve right here and the average total cost curve here, this isn't variable cost, there's going to be a point there, right? And then the average variable cost, if this is the average total cost curve, is just going to be under that, right? It's just going to be somewhere like right around there. And that point, that intersection between these curves tells us something. So in the short run, if the marginal cost curve is above the average variable cost curve, then that means, right, things are getting more expensive. The marginal cost is higher than the average variable cost. And you can see that the marginal cost kind of keeps going up here to the right, and then the average total cost is more of a U-shape. And you see a lot of U-shapes, you see a lot of inverted U-shapes as well. And so we have another relationship with not the average variable cost curve, but the average total cost curve. And then we have entry and exit conditions, and this relates to where the MC, the marginal cost curve, is in relation to these variable cost and total cost curves. So if price is above the average total cost, then you're going to enter a market because a firm thinks they can make profit. And if the price is below the average variable cost, then a firm is going to exit a market. And that basically just says if you're losing money, you're not going to produce. And if you think you can make money, you're going to produce. And this is kind of that, again, that rational look at firms where they're looking at all markets and all goods, and they're saying, where can we allocate our capital and our labor and our inputs to production to turn a profit? And in nearly every economic model, like over the long run, in a competitive equilibrium, so in a market with lots of firms that compete, no one is going to make economic profit. And that is different from what we may think of as profit. I won't get into that for now, but just keep in mind that firms in competitive markets do not turn a economic profit. So next we have market structures, and I touched on this previously, where there's different kinds of markets, and even right here where I said competitive equilibrium. So we have the economic model that you'll hear a lot about and study for the most part of perfect competition, where you have lots of firms that compete, and they compete with products that are the same, right? So let's say you have 10 different, I mentioned the Texas Instruments, the calculator company. You have, let's say, 10 firms producing calculators, and all of those calculators are the same product. There's not one better calculator, and they all serve the same function, right? They do math well. And so in that sense, you would have, let's say not 10, but let's say theoretically 1,000 producers like that. You would have this model of perfect competition. And in this model, those firms just accept the price that the market gives to them. They don't have control. They can't go and start selling their product at a much higher price because, well, no one would buy it because it's the same as all the other products. So instead, they're price takers, not price makers, which we'll see price makers in a second. And in this kind of the equilibrium, or kind of the steady state where the market's going to get to in this model of perfect competition, the price is going to equal the marginal revenue, which is going to equal the marginal cost over the long run. And there's a lot of theory that goes into that I won't get into. Just keep that in mind. Price equals marginal cost equals marginal revenue in the long run. And what that basically says is resources are being allocated efficiently, and these firms are not turning an economic profit in the long run. Then we have oligopoly, which ties into how you're taught about, or it's kind of how game theory is introduced as well in most kind of academic curriculums. And an oligopoly is somewhere between a monopoly or a duopoly, where you have respectively one or two firms in a market, and perfect competition, in which you have many. And it's a market in which you have a few, like let's say 3, 5, whatever the number is, a few dominant firms that aren't just accepting the price that's like given to them by the market, or that the market sets. Instead, they have this strategic decision-making power. So you have two kind of big models there. You have Bertrand and you have Cournot. And then the difference between there largely is that in one, firms compete on price. In Bertrand, in the Cournot model, firms compete on quantity. And you also have two other versions of those models where the products are all the same in one version, That's kind of like the default, or there is some difference in the products, and then you're competing on kind of the product side as well, and that's just called like the Bertrand model with differentiated products. So then we have the game theory side of it. I've made other videos on game theory. You can check them out. I find it really interesting personally. And to illustrate kind of some game theory concepts, we can just use the very classic prisoner's dilemma setup right here. And you've probably seen it before, but it is the classic one for a reason. So I'll just run through that pretty quickly. And in this case, you have two players. It could be two firms, two just any actors who can either cooperate or they can betray. And the classic setup for the prisoner's dilemma is you and you're in prison with someone else, like let's say from your gang, like you're a gang member that's in prison, and a police officer says, well, you can either cooperate with us. Or excuse me, you can cooperate with your partner, with this other person from your gang that's in prison, or you can betray them and cooperate with the police. And if both of you betray, then you're both going to get you're going to spend more time in prison because you both just ratted each other out. If you both cooperate with each other and you don't rat each other out, well then, neither of you, you're going to get a lighter prison sentence, essentially. And if one of you rats out the other and the other person stays silent, well then that person, the person who stayed silent is going to get a lot of jail time, and the person who ratted the other out is going to get no jail time. And that's represented here with the different kind of the rewards here, right? You and these represent kind of utilities in a sense, like we talked about previously. And so what we can see in this little setup here is the amount of years that these guys are going to spend in prison. We have 1 year. Oh, excuse me, skip the slide there. We have 1 year, 3 years, 2 years, and obviously you don't want to spend any time in prison, so a lower number here is better. But what we can do is, by looking at this, is say that the actual equilibrium here is this lower right quadrant where both players betray each other. And that's because if you're in this position, then player A has no incentive to play cooperate instead of betray, because they'll get 3 years in prison instead of 2. And same thing with player B. They're getting 2 years in prison right now. If they went over to cooperate, they would get 3 years in prison. And that is what an equilibrium is. No player, no actor has an incentive to do something else, right? They're all playing kind of optimally or rationally. And so even though cooperate right here would get both of them less time in prison, because of the threats here, they put themselves in a worse position, and that is kind of how you play the game. And that's like the super basic kind of intro to equilibriums and to dominant versus weak strategies, and to a lot of what you see applying in economics. And then it's really the math of this that then gets taken and then applied to oligopolies in these Cournot and Bertrand models, and also just collusion and cartels and that whole 9 yards as well. We also have monopoly. I'm not sure I included that here, but monopoly is just one firm that is a price maker in a market. So instead of accepting the market price, if you're a monopoly, you set the price. And this all ties into then welfare analysis. So you have consumer kind of surplus is kind of like the value that consumers get minus what they pay. Producer surplus is the value producers get after what producing something costs them. And then you have kind of what's called the dead weight loss, which is, in the case of, say, a monopoly, like how much worse the market is, how much worse people and producers are worse off because of one monopoly that controls the whole market. So then we have market failures. And I just mentioned like dead weight loss is a market failure. Market failures generally are just problems with kind of free markets and things that go wrong that result in what's called that welfare loss. And you have externalities first off. Externalities are not by default bad for all players involved. But externalities are things that you do which affect other firms, other people. So let's say you're a firm and you Classic example is like you have a factory that produces pollution. Well, that pollution is an externality for, say, the people living in the town. And it's an externality for you in that you're not factoring the cost of that pollution into your production function or what it costs for you to produce that good. And so you can actually, and there are models in which you then take that cost that is incurred by the externality or the social cost, and you merge it into the private cost to see the actual kind of cost there. And then you have other externalities, right, like education, R&D. In that, for example, if one firm researches something and there's an innovation, then the whole market can be better off because they can, let's say, all use that new production process. And that's why we have things like patents to protect IP and to encourage people to still invest in R&D, even though it's a positive externality for their competitors. And then we have some other market failures as well. We have public goods. Public goods, like a good example is just a public bus, where if you're a taxpayer, you're funding in part that bus, but there are people who may use the bus, and let's say it's a free bus, who aren't paying taxes on it, right? Like let's say they don't make any money, they're homeless, or they just, I don't know, they are evading the law and are not paying taxes. Well, they get the public good right there. And national defense is another one there. Same thing with common resources, and you have this thing called tragedy of the commons that I've mentioned in a previous video as well. Basic example there is just there are, let's say, a certain amount of fish on a lake, and people go in and they catch all the fish, and now no one has any fish, and that's bad. But the reason and the problem there is that, well, each player, each individual fisherman has an incentive to go and fish and to go get more fish for their family and to sell. But if everyone keeps doing that, given that they all have this individual incentive to keep fishing, then, well, you run out of fish, and now everyone is vastly worse off. So it's an incentive problem in a sense. You also have information asymmetry. That just means some information is private, and people and firms and people in firms interacting, right, don't all have the same information, and that can bring about failures in certain markets. Insurance is a good example there, right? Like if you lie about your medical or your health history to a health insurance provider, they may give you a lower rate. And well, why did that happen? And why does that inefficiency happen? Because of this information asymmetry. And there's a lot more there with moral hazard as well that I also talked about in a previous video. So now we're getting more into macroeconomics. I don't think I probably should have included a title slide, but for macroeconomics, we can start off with thinking about national income accounting, which is, well, and we're going from one firm, a few firms in a market and consumers, we're going into the whole country now, that whole market. And we're saying, well, how do we measure how much is produced in this national market? And you have a few models as well to determine on a national level how fast do things grow, and also why do they grow. Now, national income, you can just think of that as GDP, and that's basically how we all measure how much is produced on a national level. And there are three common approaches to calculate GDP. There's the expenditure approach, the income approach, and the value-added approach. They're all just slightly different and theoretically should get you to the same number. And then the equation that is used here is output. So it's normally denoted as Y. You can also think of it as just GDP. It's consumption, investment, government spending, and then some combination of exports and imports. Now, as far as like I said, the theories go for the growth of the, say, a whole nation state and their market, you have this growth model. It's a very common one that just says, and this is kind of like what we talked about previously with the Cobb-Douglas and the production functions, and this kind of is a production function in that sense. But we say that capital accumulation, labor force, so amount of people working, and technological progress. So these three things right here is going to determine over the long run, this steady state, this equilibrium for the market in term when we think about the growth of that market. And that's how we can get to certain facets of this model. So like, well, what happens when on a national level the saving rates goes down? What happens when people or firms invest more, and so on? So there's a lot there. You normally hit that, I think, in like macro, not 102 or like the first course where you learn about it, but kind of that one second order, the higher level course. So then we have more aggregate models. We have the ISLM model and the ADAS model. I don't want to spend too much time on these, but basically they represent the goods market in terms of the ISLM model, and then the money market as well, with the LM curve representing liquidity preference. So basically, do people want cash versus other investments? And then the ADAS model also looks at that long run kind of national level of your output and what determines, growth. And that also proves stagflation. And there's also debt cycles and traps that you'll see in these models as well that do really play out in the real world. Okay, so we can use these aggregate models to look at kind of a few components then of macroeconomics. The first of those is going to be money and banking. And specifically, we have central banking and monetary policy, which are kind of two sides of the coin that the government uses to regulate money. All different governments around the world. So you have the central bank in the U.S. That's the Federal Reserve Bank, the federal bank, and then you have monetary policy. So that's things that the executive branch in the U.S. Can do to influence money and banking. And they have a few goals, right? The government, the central bank, they want price stability, they want financial stability, and then they want growth. So they want prices to, not grow at a very high pace. Otherwise, people get unhappy and people vote those people out of office to bring in other guys that hopefully can stabilize or decrease prices while maintaining growth. And it is usually a kind of trade-off there. Like if you have super high growth, then you're going to get often inflation. You're going to have just the systems will be out of whack, and typically the equilibrium or the steady state of an economy is growing by a few percent a year, but it's not crazy high growth. Like that's not where markets should be. And then they have a few tools that they can use to achieve this. They have open market operations where they're buying and they're selling bonds. They have reserve requirements where they dictate the amount of money that banks have to keep on hand, which then in turn impacts the price of loans that banks give out and how many loans. Then that impacts in turn the economy because really the ease by which money can be borrowed is kind of the big determinant of growth, or one of the big determinants of growth. And then you also have money creation in the banking system where the government actually, creates money. And we run on a fractional reserve system. And what that means is banks that loan out money don't actually have to have all of the money, all the deposits that you put in their bank on hand. They can loan out most of that money. So if you see, if you deposit $1,000 in a bank and you see your $1,000 number there, they probably went out and loaned $990 of that, or $995. But because they have the little, the 5% of your money in the bank, and they have 5% of everyone's money that's deposited it, then if you want to pull all of your $1,000 out, which presumably isn't going to happen all the time, then they can go and pull everyone's money together to pay you back. And so is that like a Ponzi scheme? Maybe, but it works and it is effective in practice. And the amount of money, the reserve rate that I just mentioned, that the banks have to keep on hand, that is a tool that the government can use to regulate economic growth. And you have a few different measurements of how much money exists in the system. They're called just M1, M2, and M3. They all just look at and track slightly different things. And then you also have interest rates and credit markets. And interest rates are big, right? The rates on treasuries, the implicit kind of interest rate is a really, really big thing. when you think about how growth works on the national level. And you see things like the yield curve, which you hear about if you listen to stock news or stock analysis or whatnot. And the interest rate is kind of like the risk-free rate of return on money. And that determines, going back to microeconomics, how you want to invest and allocate money. Because if you're a firm and you could be earning 6% in interest with a treasury bond, right? That's very different from a world in which you can only earn 2% interest. If you can make 6% doing nothing with your money, maybe you just want to stick money there and not go invest it to make 8% a year. Because then you take on all this risk, you put in all this effort just to make an extra 2% a year. However, if you only make 2% a year with your kind of risk-free rate of return or your interest rates, well, that's a very, very different situation. And now maybe you want to go and put the effort in to make potentially 8% on an investment. And so in that sense as well, typically if interest rates are really high, if your risk-free rate of return is very high, then you're going to invest less and vice versa. And that's one of the tools that the central bank can use then to, again, just achieve these goals of price stability, financial stability, and economic growth. So then we have international economics, and this gets into not just one nation for macroeconomics, but multiple nations that interact. So we have international trade theory, which is, well, how do nations interact? And in a lot of ways, this comes down to first factor endowments. So like maybe there's more good land that's good for farming in one nation, and there's more water, which is good for, I don't know, fishing in another nation. And those are kind of endowments on a national level, or things that are implicit to those nations that help them then with producing and with trade on a national level. You have trade policies, which is a whole thing in of itself and very on the nose right now, right? Your tariffs, especially. And then you have exchange rates and currency markets. So not how goods interact among nations, but how money and currencies interact. And that's where you get a determination of exchange rates, or the interactions between different currencies. And you get a lot more here, especially purchasing power parity is one type of evaluation of GDP. So if you Google like GDP of China, it'll say that their PPP is bigger if you value their currency in that way versus the other ways. And there's a whole world there as well. Then we get finally into economic policy, and this is what I briefly touched on back here, where we're saying, well, there's monetary policy where the government wants to achieve their set of goals, typically stability and growth. And well, how can they do that on the executive side? So what can, say, the president do? And so what they can do is taxes, right? If you lower taxes, everyone has more money, it's better for growth. But now, well, the government revenue went down. And it's always those trade-offs again. And the same thing with debt, with government spending. And something that you'll hear a lot is kind of the government spending multiplier, where if the government puts $100 million in stimulus into the economy, it's not actually worth $100 million to the economy. It might be worth $500 million or $1 billion, because they give out directly $100 million, but then that $100 million may be paid through services to other companies, and now you get $200 million in effects, and that creates new jobs and so on, and that kind of that trickles down. And then the degree, the volume by which it trickles down, whether that's a 5x or a 10x or a 20x, is that government spending multiplier. Then in terms of monetary policy objectives, right, typically you don't want extremely high inflation, and you have liquidity traps, which I mentioned earlier, and those are things like the debt spiral that you can get into when what's called the zero lower bound is crossed. And so you have quantitative and qualitative easing. That's another monetary policy tool kind of employed by the government. And you have things like, you have things like regulation and investment in human capital. Human capital just meaning the skill of your workers. So that wraps up micro and macro economics at a very high level, just to introduce you to all of these components. Okay, so next up, and for the final component here before electives, we have the world of econometrics. And this is personally my favorite beyond a lot of the theory that we see in micro and macro economics, because econometrics is more about just answering questions using data. It's specifically about answering economic questions using data. And so it feels very actionable, very grounded in reality, and also very useful for me. This starts in just statistics, right? Econometrics in a lot of ways is just an applied form of statistics to the world and the problems presented by economics. And so it starts with probability theory and then descriptive statistics. Probability theory meaning, well, we have random variables, we have sampling distributions, and then we have, our p-values, or just a lot of numbers, and a lot of models that are used in statistics that are applied then to econometrics that you'll need to know. Same thing with descriptive statistics. These are just kind of like the tools that you use to then go and do econometrics. So mean, median, mode, variance, and then also data visualization, which I'll talk about more in a few minutes, that you need. And then, like I just mentioned, with p-values, you have what's called hypothesis testing, and this is kind of the core, the heart of a lot of econometrics, where, and this is also though just statistics, just applied again to economic problems. Whereas if you test a hypothesis, you have what's called the null and the alternative hypothesis. It's kind of weird to wrap your head around a few of these things. The null hypothesis is like the chance that you're wrong, because the null of your hypothesis is like the opposite, or just the hypothesis being incorrect. And so you're trying to disprove the fact that you're wrong, or disprove the null hypothesis, which is equivalent to just different terms really to proving that you're right. And you do that through p-values and significance levels. And in a lot of like what are called regressions, which I'll get to in a second, but in a lot of these tables, you'll see the significance, and then you'll see dot, and then some number, some fraction. And what you want, and what the most significant results are significant to the 1% level. And that basically means that you're 99% or more confident that the null hypothesis is wrong, which is to say, you're 99% confident that the fact that you are incorrect, which is to say you are 99% confident that you're not wrong, or basically that you're right. It's just, we call it the null hypothesis. And so by technicality, it's disproving the fact that you could be wrong. And then you also have the 5% and the 10% significant levels. And of course, lower number is better, right? You would rather be 99.9% chance that you are right versus 89.2% or 95.6%. And then you have t-tests, f-tests. You really are just, the core of this is going to be p-values and significance levels. And then you use that to run what are called regressions. And regressions is just a thing you can do with statistics. It's an approach to solving a problem that helps you look for patterns in that data, and basically to analyze kind of the fit. And that's really useful in a lot of ways, and regressions really are how the whole world in econometrics and beyond as well solves a lot of very big problems and questions, and explains a lot. Like most statistics that you see, like there's a 18% chance that something happens if something else happens. Those all come from regressions. And the standard regression model is right here. It's the y, so the dependent variable equals this beta 0 value, which is you can think of this as like y equals mx plus b, or this is going to be the y-intercept. Or if your independent variable is 0, then what is your intercept? So that's like the value. If on this line, if you were at 0 down here, where would you be on the y-axis? and then you have some coefficient multiplied by that independent variable, and then the error term as well. And so basically the unknowns here are these coefficients, right? The intercept and the coefficient on the dependent variable. And so what regression analysis does is it minimizes the sum of the squared residuals, which basically just means it figures out the numbers that work or predict the result the best. So in this case, the line of best fit, and the line right here, that equation is just literally this, right? It's just like, again, y equals mx plus b. You have mx right here, you have b right there, if you're familiar with just algebra, basically. So this out of, so I would say this is like top 5 important thing all around. Like, go watch some videos on, you know, regressions if you're interested, or if you want to get into this. And then this is a simple linear regression. We just have one coefficient. We have the intercept, the error term. In the multiple regressions model, right, we can have a whole lot. We can have control variables, dummy variables. So in this case, right, you just expand that same model, but the fundamental model is the same. We're just throwing more of these potential independent variables with coefficients in there, right? So we can generalize that to beta k, x, k. So that's regression analysis. You'll also need different kinds of models potentially, and you'll need to kind of adjust these base regression models or the data itself just to answer the question you're trying to answer better. So you can do, for example, you can throw in a quadratic element. So there's no exponents here. And if you want to test for a relationship that has inflection points, for example, like it's not just a downward, like a straight line like this. Let's say it goes up, it goes down, it goes up, it goes down. Well, then you can throw in your higher order exponents. You also need to, a lot of the time, take the log of certain variables and then use those. And there's just a whole world of other little changes, little things you can do to, again, the model and to the variables, so variable transformation as well. And then finally, all of this comes down, or what you feed into these models is data. And so, at least in my academic experience, we're taught using stata or stata, however you say it, to do a lot of the actual math of the regression for us and to manipulate our data. And then coding-wise, Python is super useful to do all of this stuff in, and really helpful across the board for econometrics. I prefer it, and I do a lot more work in Python than I do in R. But R is kind of a coding language that is designed specifically for statistics, and so that's also taught more on the master's level as opposed to undergraduate in my experience. But it is, useful. For sure as well, in some ways. I'd say Python is still the more general skill that you want to know. And so when you feed that data into your regression models, you're going to have missing values, you're going to have outliers, and you're going to need to do a lot of work to this data. And that is one big part of the whole kind of econometrics process of, I have a question, I'm building a model to answer the question, and then I have the data that I can use to feed into that model. And then finally, you also need to visualize that data effectively. And I think that is one kind of underappreciated part of econometrics, where if you want to share your results, sure, you can do it through a bunch of tables like this, but people respond in a lot of ways to, to your graphs, to your plots, to just clear ways of seeing the impact of your data. And so you can do a lot of that work in Python. Most chatbots today, to be honest, can probably do help you out with that if you're not familiar with the actual programming. But that is one core part after you have your results as well, of how do I format, how do I share this data. So there we go. That is econometrics. That was a super quick and dirty rundown, but that touches on the whole process of econometrics. Okay, so now we're on to electives, and the first there is game theory that I want to discuss. Now, I made a full video, you can see that right here, about game theory and also mechanism design. I love it as a subject, I find it really interesting, and if you do want kind of a deeper dive, you can check out that one. Generally, and we'll get a little bit deeper into it in just a second, but game theory is about strategy. It's about decision making. And there are two sides to that coin. Game theory essentially says we have a fixed game, and then we have people or actors in the game that can make decisions. And what kind of decisions are they going to make, and what kind of decisions should they optimally, rationally make? And when you think about that, that is a host of applications, right? Like nuclear proliferation is just the classic one, right? War, negotiation, politics, business, all of that is fundamentally in a lot of ways about optimal decision making given other actors, given decisions that can be made, and given kind of the outcome set, and given the outcomes that could happen and how likely you think each of those outcomes are. And then the opposite of game theory is mechanism design, where the behavior of individuals is fixed. Like, let's say an individual is fully rational, these are their risk preferences and so on, and then you design the game to get an optimal outcome. So in one case, in game theory, which is far more popular as a field, you want to get the optimal outcome. You want to maximize your utility as an actor in a game. And so you use math, ranges from mostly algebra, but all the way up through calculus. And you just have to figure out, what are people going to do? Now, game theory under the hood is it has two parts as far as the approach goes, I think. The first one there is just pure logic and thinking through things. Like, a lot of game theory makes sense. Like, most of it makes sense when you just think about it. It just can seem counterintuitive at first. But once it's explained to you, it's like, oh yeah, that makes sense. I just didn't view it in that angle. And that's what I really love about game theory. It's a kind of way of viewing the world. It's a perspective that may not draw direct parallels into all situations, because life isn't as simple as, a theoretical kind of example. But that perspective is extremely valuable because it forces this kind of rational lens on decision making and this process of thinking through problems. And then the other part to it is just math under the hood, so just a lot of equations. Gets up through calculus, and the math isn't that bad. I would say it's much more about the logic of it, but there is that component in terms of how you actually solve problems. So next is economics of information. This was a very high-level class that I took as a freshman, and I had no clue what I was doing. I really enjoyed the subject. Like, it expanded my perspective in a lot of ways, but it was a really difficult one as well. And that's because it's not game theory per se, but what it is a lot of kind of optimization problems. And there's a thing called the Lagrangian, like a Lagrangian multiplier that you use to solve either constrained or some kind of just optimization problem. You use this in a lot of places in economics once you get up to a certain level. And I didn't know any of this when I took the course, but basically you have a utility function, you have a budget constraint, and the utility function is just defines kind of the way in which someone gets utility, just describes it's some function for the utility that an individual kind of gets. And then the budget constraint is, well, how much can they spend? How many resources do they have to go and get that utility, right? Like, if I have $10 and I'm choosing between bananas and oranges, I could have a different utility function for each of those, and I'm going to allocate my budget constraint or my $10 depending on the kind of utility that I get from oranges versus apples. And then to solve that kind of problem with Lagrangian, you take first order conditions and then you do a whole bunch of derivatives and you get some kind of answer. So there was a lot of that in economics of information. More generally, what that refers to is especially, or really, I think, how do you value information? How do you put a price tag and kind of really define information? Because when you think about it, information runs the world in a lot of ways. The way we act is a function of the information we have, the way the stock market works, politics, it all reflects information. So there's a whole field there that is abstract in a lot of ways, but can also seem, once you get into it, and in some applications, really practical. And it's also a very interesting perspective on the world that it imbues, just that field as a whole, where when you look at a decision, you look at it through, okay, these are the costs, this is the set of probabilities that I associate with some set of kind of states of worlds, they're called, or just outcomes. And so there could be 6 things that could happen. I'm going to weigh them with these probabilities. And then these are the costs. This is the utility I would get. And then you can do a lot of math there to figure out what you should do optimally. That, to me at least, is just really interesting subject and a really interesting way of approaching things. So I would recommend doing a little deep dive into that if you're interested. Okay, next up is antitrust law. And this is a really fascinating one, actually, and it concerns, I think, a very practical thing, which is how do government bodies, like let's say in the US or in another country around the world, how do they determine whether a company is large enough where the government should regulate it or break it up? That's the main question. There's other ones there about just more the legal side of it, like are they too large? Did they break the law? What laws are there to break? But the more economics side of it is just at what point and how do we calculate how large this company is and how much market power they have. And that's because in a truly competitive, like theoretically perfectly competitive market, firms are not going to turn a profit. But then you get beyond that. You get into monopolistic kind of competitive markets, you get into oligopolies and then actual monopolies. And in those market structures, firms can make a lot of money, and what they can do is raise their price above their marginal cost. And what that does is produce what's called deadweight loss, which just means the market is inefficient and consumers, the net benefit, the net yield for consumers and firms is lower. So across the board, you're losing out because firms have market and pricing power. And so in that field, in antitrust regulation, that whole 9 yards, you do a lot of calculations to figure out what kind of market power does a firm have, and are they raising their price over their marginal cost? And then you look at the average cost, average variable cost, just all of that stuff that you likely would have learned, or if you've dealt with micro before, you'll see a lot of kind of crossovers there. And that's another one I would recommend just because it's so useful and kind of applicable to a lot about just what you hear in the news and also a lot of the work you could potentially get into. Number 4 is political economy. My experience with this in terms of academics has had a lot of crossovers with econometrics, where what we would do is just read a large number of kind of research papers in the field. I personally don't like the more political side of political kind of economics. But it is a really interesting field, I think, in that it takes a lot of the economic lessons and approaches and it applies that to the field of politics and behavior. And in that way, it is kind of this second order, much more practical application of a lot of what you learn. And especially just studies and research on the subject that takes real data and then tests all these economic hypotheses about politics. Really interesting, and I do recommend you keep up with that kind of work if it's a subject that you're interested in. Okay, so the last elective, the last sub-subject I want to touch on here is public finance. It's a big term that can refer to a lot of things. My experience with it academically has been a lot about tax incidence. So who and where does the actual kind of burden of a tax fall on, and then excess burden, so what's the net loss due to taxes of some sort, and also just what are called life cycle, kind of dynamic life cycle models, in that you can have models in economics that are static, which means it refers to kind of one period in time, some fixed set kind of functions, or you can have a dynamic model, and a dynamic model may incorporate multiple time periods. And specifically, what I've done a lot of work with in public finance is kind of multi-generational, temporal, again, life cycle models, where you look at the whole kind of life cycle of a market, the world, just whatever that context may be. This one is definitely more abstract, or at least that side of it, but it is really applicable in terms of especially policy. So if you want to get into policy, that's something you're thinking about, then 100% go learn about public finance. So there you go, that's the video. I do hope you enjoyed, and I want this to be informative as well and actually useful to you. So make sure to leave any comments or just shoot me an email if you're thinking about pursuing something like this. And if you're just curious, again, just drop a comment and we can discuss any kind of economic subject that you are interested in. And that said, again, make sure to go check out that exclusive promo code for Prop 365. And I'll see you in the next one. Cheers.